Hey everybody, welcome to guided assignment for chapter 23. I'm hearing that the other one has audio problems, so I'm re-recording it for you here. I apologize if it slowed you down in doing your homework. So the first part of this guided assignment is a flexible budget performance report. Mine is Preston Industries. And so what we have to do is just sort of put all this information in the performance report. So let's just get to it. Top managers at Preston Industries predicted 2018 sales of 14,500 units of its product at a unit price of $6. Actual sales were 14,200 units at $8.50 each. Variable cost, yada, yada, yada. So there's all our information. So I'm just going to kind of go through this information and break it down. So the expected units is their static budget expected units, 14,500. And then their actual units was 14,200. And our flexible budget is always done at the actual results as far as the number of units. And then it tells us that, let's see, they predicted 14,500 units at sales at a price of $6. So their sales revenue per unit budgeted was $6. And the variable costs were budgeted at $2.60. And then the rest of this we have to calculate. So we'll start with our actual results. It says the actual sales for the year were 14,200 units at $8.50 each. So 14,200 times $8.50 is our actual sales revenue of 120,700. Our variable costs were budgeted at $260 per unit, but the actual variable costs were $270 per unit. So if we take the number of units, which was 14,200 times $2.70, that gives us our actual variable cost of 38,340. And then our contribution margin will just be our revenue minus our variable costs. So 120,700 minus 38,340, or 82,360. For our flexible budget, so again, we're going to use the volume or the number of units of our actual, but we'll use our budgeted amounts. So we'll say for sales revenue, 14,200 units times $6 per unit. So our flexible budget amount is 85,200 for revenue. And then 14,200 units times $2.60. 36,920 is our variable cost. And our contribution margin then for the flexible budget is 85,200 minus 36,920, or 48,280. For our static budget, we're going to use the amount budgeted, which is 14,500 units, and then the budgeted per unit amounts. So for revenue, it's 14,500 times $6 for $87,000 in budgeted revenue. Variable cost, 14,500 units times $2.60, the budgeted variable cost, which is 37,700. And then our contribution margin will be 87,000 minus 37,700, or 49,300. All right, so now that we've got all that figured out, we're ready to figure out our variance. And the variance is just the absolute value of the difference between each of these columns. So for sales revenue, our flexible budget variance is going to be 120,700 minus 85,200, which is 35,500. And then for our variable costs, flexible budget variance is going to be 38,340 minus 36,920, which is 1,420. And then our contribution margin, again, will just be the difference between the two. So 82,360 minus 48,280, $34,080. Like I said, this is an absolute value. So even if these had been negative, we're still going to show them as positive. And then we have to assess whether these are favorable or unfavorable. So we don't ever show things as negatives. Instead, we say favorable or unfavorable. So as we're comparing the flexible budget variance, we're saying were our actual results better than we expected or worse than we expected. So when our revenue is higher than what we expected, we would consider that favorable. More revenue is a good thing. Here, our expenses were higher than expected, or our costs, and so more costs than we expected, we would consider to be unfavorable. And then contribution margin was higher, so a higher contribution margin we would consider to be favorable. We're going to do the same thing for our sales volume variance. Again, we'll just subtract them, 85,200 minus 87,000. Remember, I'm recording the absolute value of that difference, so I'm just going to record that as 1,800. So we would say, okay, so our static budget was $1,800 more than our flexible budget. So again, we're comparing the flexible budget to the static budget. So if our flexible budget is less than our static budget, we're going to consider that an unfavorable variance when it comes to revenue. Our expenses, 36,920 minus 37,700. That's 780. Again, we were going to record the absolute value, so no negatives. And in this case, if our expenses and our flexible budget were less than our static budget, we're going to consider that favorable. We had less expenses than what the flexible budget says we should have had. Finally, for the contribution margin, $1,020 is our variance. And let's see, so if our contribution margin is lower, which it is, we're going to consider that unfavorable. All right, now we're going to do our fixed costs. So our actual fixed costs were $43,000. But our budgeted fixed cost, it says our $43,000 actual fixed cost exceeded the budgeted fixed cost by $5,500. So that means 43,000 minus 5,500 would be our budgeted fixed cost of 37,500. All right. So now we'll find our operating income, which is just our contribution margin minus our fixed costs for each of the items. So 82,360 minus 43,000. So 39,360 is our operating income. Actual results. On our flexible budget, 48,280 minus 37,500 is an operating income of 10,780. And then on our static budget, 49,300 minus 37,500 gives us an operating income of 11,800. All right, so now we're ready to do our variances. Again, the same way, we just subtract the one on the left, or I should say we subtract the one on the right from the one on the left. So 43,000 minus 37,500. And then we report the absolute value. So that is a $5,500 difference. So in this case, if our costs are higher, that's unfavorable. Just remember this, if your costs are higher, you'd consider that an unfavorable thing. If your revenues are higher, you'd consider that a favorable thing. If your revenues were lower, you'd consider that unfavorable. And if your costs are lower, you would consider that favorable. So just think of it in those terms. So our operating income, 39,360 minus 10,780. So a difference of 28,580. And I don't know about you, but I think having an operating income that's higher is a favorable thing. Okay, we'll do our variances here. So here we have no variance, so I'm just going to put 0, and I won't mark that as favorable or unfavorable. It's neither, or maybe it's both. I don't know. Our operating income, again, 10,780 minus 11,800. That's $1,020. So since our flexible budget operating income is less than our static budget, we're going to consider that an unfavorable variance. All right, now they want us to, I guess, define these. So the difference between our actual results and our flexible budget is called our flexible budget variance. And we already figured it out right here, 28,580. And we already agreed that it was favorable because we had more net income than what we planned to have. The difference between our flexible budget and our static budget is called our flexible budget, or sorry, our sales volume variance, because it's based on the difference in sales volume. And here we already figured out that was $1,020 and that it was unfavorable. Finally, the difference between our actual results and our static budget is going to be called our static budget variance. And that difference is, I'll just have to take the 39,360 minus 11,800. Just 27,560. And that's favorable. We made more money than what we thought we would. All right, finally, it's going to ask us what caused this variance. So the variance contributing most to this year's results is the favorable blank. And it's going to be this amount of sales revenue, right? This variance in the flexible budget. So we're going to say the amount of flexible budget variance for sales revenue. This variance resulted from selling the company's product at blank. And the answer is we planned on selling it at $6 a unit, but we sold it for $8.50 a unit. So it's selling it at a higher price than we expected. And that should be it for the first problem. All right, so here's the second problem. So this one is Goldman Inc. manufactures lead crystal glasses. The standard direct labor time is 0.2 hours per glass at a cost of $17 per hour. The actual results for 1 month's production of 6,000 glasses were 0.4 hours per glass at a cost of $14 per hour. Calculate the direct labor cost variance and the direct labor efficiency variance. So the first thing I have to do, they just want the formula. So I'm going to say this is our actual cost minus our standard cost times our actual quantity. So there's the formula. And then we just have to fill it in really. So our actual cost, let's see, is $14 per hour. And our standard cost was $17 per hour. And then our actual quantity, and that's like actually like our quantity of hours, okay? Since our cost is per hour, so our actual quantity of hours was 0.4 hours times 6,000, or 2,400. So our direct labor cost variance is going to be 14 minus 17 times 2,400. And variance always gets listed at absolute value. So we're going to show this as 7,200. And then we're going to call this a favorable variance because our cost, our actual cost is less than our standard cost. So that we consider that favorable when we have a lower cost. And the second part is select the formula, then enter the amounts to compute the efficiency variance for direct labor and identify what the variance, whether it's favorable or unfavorable. So our variance here is our actual quantity minus our standard quantity times the standard cost. That gives us our direct labor efficiency variance. So again, we just fill in the numbers. So our actual quantity, we already figured out right here, which is 2,400. Our standard quantity would be 0.2 times the 6,000. It should be 1,200. And then our standard cost, which is 17, equals our direct labor efficiency variance. So 2,400 minus 1,200 times 17. Oops, something's not right there. Let's see. 2,400 minus 1,200 times 17 is 20,400. And let's see. So since our actual quantity is higher than our standard quantity, now I'm confusing myself. I'm going to call that unfavorable. Let's see if I'm getting confused. Nope, that's right. So if our actual quantity is higher than our standard quantity, then that's going to be an unfavorable variance. And that's it. So on to problem number 3. Okay, so the following information relates to Brook Inc.'s overhead cost for the month. Let's see, so here's the information. And then Brook allocates manufacturing overhead to production based on standard direct labor hours. Compute the standard variable overhead allocation rate and the standard fixed overhead allocation rate. So the first thing, we have to do the formula for the variable overhead allocation rate, which is going to be our budgeted variable overhead divided by our budgeted allocation base. And our budgeted variable overhead is given to us right here, 7,800. And our budgeted allocation base is direct labor hours for this one, and it's 1,300. So our variable overhead allocation rate is 7,800 divided by 1,300, or $6. Now we have to do the formula for our fixed overhead allocation rate, which is the budgeted fixed overhead divided by the budgeted allocation base. And then our budgeted fixed overhead is $3,900. Our budgeted allocation base, which I believe is number of units for this one. No, it's not. Let me see. Okay, so it's still, let's see, standard direct labor hours. So it's still direct labor hours, which is 1,300. So that should be $3, right? 3,900 divided by 1,300, $3. And that's it. So hopefully that wasn't too bad. I think the first one was the longest, nastiest one, and the other two aren't too bad. So good luck on this, and let me know if you need additional help.